Some stocks are up and some stocks are down. So today we're going to do a broad overview, what we think are the most important forces in the market, and then we'll go over our entire portfolio construction, which we feel is very good and had very good areas today in the market. And even in an unsettling day today, with a lot of ambiguity, we feel very strong and confident and comfortable in our positions. Now, what do I see impacting the market, and what do I think is the most important thing to look at and to build our portfolios based on? Well, today we had some inflation talk out of Jerome Powell, not using the term transitory, and we've been playing the inflation game and winning because of it. There's been a lot of skepticism on whether or not inflation is going to occur. It's going to be transitory and then it's going to come back down. Well, that camp, while they may end up being right in the long run, has yet to be right because they have been the ones being surprised. Those of us prepared for something like this have not been so surprised, and everything seems to be just going as planned. Inflation is something we kind of expected. Why will inflation occur? Well, we've had significant increases to the money supply, as I'm sure you're aware of, in addition to other things like supply chain bottlenecks and labor increases. Now, supply chain bottlenecks likely will alleviate at some point, although that is going on way too long, and it's unfortunate. We're going to see what happens around Christmas time. But we've had supply chain issues. They come and go, and that doesn't seem to really have a prolonged effect on inflation. With regards to the labor shortage situation, or the rising price wage situation, people say that with innovation, this isn't going to matter because innovation is going to drive down the cost of labor, or at least drive down the cost of producing goods. And I raise a serious issue with this claim because that is not a new notion. We've had innovation, we've had automation for decades now, if not centuries. Things like the printing press, the windmill, and most importantly, most revolutionarily, and most order of magnitude-esque for production, we've had the assembly line. Now, with the assembly line, a Ford Model T used to be just a few $1,000s. Now the cheapest Ford is $20,000. Why is this the case? Well, one thing is increases to the money supply, but we'll get there in a second. With more automation and with decreases in the price of labor and the ability to produce more goods more easily, comes more demands. You got to fill a void. All of a sudden you got this extra void. People want better things. Innovation also creates more complex and new things that consumers desire. So products just increase in complexity, and that leads us to a point we're going to get to in a second after money supply. Materials and commodities and the stuff that makes the stuff. We're going to get there in a second. Finally, we're going to talk about the money supply and the monetary issues surrounding inflation. We've done a massive amount of stimulus. We have printed some money, and we've lowered interest rates. Now, interest rates are going to go up, and typically when interest rates go up, people hold on to their dollars, dollar index rises, and the demand for dollars grow because it's not as easy to get, quote, free money. However, I'm not sure this is going to have such a strong effect. There's plenty of money out there. The rich have gotten very wealthy. There's been a whole lot of buying bond assets. So the Federal Reserve has bought the immense amount of debt the United States government has issued. And rather than that being in the hands of people, collecting their interest payments every year or so and getting the final payment in 30 years, the Federal Reserve has given them a whole lot of money now. And that money doesn't necessarily disappear. That is in the system, and that leads to a 40% increase in the money supply. That can't be combated so easily. If you look at German hyperinflation, I'm not saying hyperinflation is occurring. I'm saying inflation is occurring, and 5% plus increase is quite substantial. It's way better than a bond. And the bond market used to be quite attractive, and it no longer is because of that notion. So that's highlighting and illustrating how powerful this situation is. Anyways, I lost my train of thought there. Money supply, 40% increase. Interest rates. If they increase interest rates back to historical levels where they should be in an unmanipulated market, and the Fed is beginning to loosen its tapering, aka manipulating the market, the United States government will be spending 30% of its income on debt servicing. That is a tremendous portion of our national wealth going to debt servicing. I don't know how that's going to work. Maybe they're going to have to do another round of printing money and quantitative easing, or they're going to have to do more debt purchases. There's been a whole lot done. There's still a whole lot going now. The Fed is buying close to peak levels still, even 17, 18 months on, of debt. And there's more to go. Even as they go down, there's several months of a gradual decline and stuff to come after that. So there's a bunch of monetary forces at play. A lot of the damage has been done, and we have yet to even see the full force of it. And the cherry on the icing on the cake, Jerome Powell today says into 2022. That is longer than they had initially expected. And I think that highlights the entire situation. It's unpredictable, but with a little common sense, I think we can be right with common sense here. We'll see. Still, as I said, a lot of uncertainty. Now, this is obviously a very interesting and strong underlying force around the market, and we don't want it to impact us. If we had bonds, it certainly would quite substantially impact us. However, there are areas of the market that we can play to benefit from inflation, and we're doing just that. And we're going to run over everything and highlight some portfolio construction for you. So I previously talked about the stuff that makes us stuff. Mining companies and materials companies are very cheap. Some of the cheapest stocks in the market relative to how much cash they produce. And one might say, well, I don't want cash because cash is trash in inflation. Well, these companies, more so than virtually every other company, have the ability to adjust their cash flow as needed for inflation. So as prices rise, the materials prices rise most. They also pay big dividends. So even in a year where the stock stays flat, you will get a return. This return is also adjustable for inflation. I don't think the demand for steel is going to go down, especially if they're expecting an infrastructure package and the world seeks to continue to grow, which I feel optimistic it certainly will. In addition, there's a massive revolution going on. Electric vehicles, drones, etc. These use precious metals and important magnets, and there are mines that produce this stuff like MP. So if you want to get a little more risky out there and get into the more high beta names, I would take a look at something like that. It's a very interesting stock, and I happen to have some. In addition, there are other mines that produce things from steel, gold, copper, iron ore, and nickel. Those are my favorite materials. You can also go into uranium. That is an interesting material. We'll see what happens with that over time. I have an exposure to these metals, and I feel very confident that regardless of inflation, I will be making money. They're very cheap. They're good businesses. Even without inflation, I would certainly find a place for them in my portfolio. However, they will benefit from inflation. And in a situation where it doesn't seem like there's a whole lot of places to go, materials presents a very good place to go. In addition, we also like energy stocks here. Energy stocks are grossly underpriced. Similar to mining and materials companies, they're very cheap relative to how much in earnings they're making. Energy companies have had a very good Q2, and as they come out, they're likely to have very good Q3s. However, Q3s. However, the strongest quarter of all by far is likely going to be Q4, where the price per barrel is remaining very high. And like mining and materials companies, these companies adjust very well with the with inflation, and inflation is the rise in prices. And energy prices, I'm sure you're aware, have risen quite substantially and have shown no signs of falling. A couple days ago, we made a video titled $80 a new floor for oil. And that was tested yesterday as we had a very sharp decline in the morning, and then we had a recovery during the day. Then today, we hit new 7-year highs. However, many of the energy stocks, majors at least, like Schlumberger, Exxon, are lower than they were yesterday, or at least lower than they were at the highs of yesterday, despite the massive plunge. This is a theme that has been going on in energy stocks for a while now that I think adds to their appeal. For years, investors have shied away from energy stocks because they have feared the death of fossil fuels, natural gas, etc. And when stocks fall or when the price per barrel declines, you feel it in your stomach. Whoa, maybe I should just get out of this, cut my losses, and buy some Tesla. We like Tesla over here. We're not going to get into Tesla today, though. However, at the end of the day, these companies produce cash. And the IEA, the Government Energy Association, expects oil to remain the primary energy source until 2050. However, they are not priced as if they're going to survive until 2050, even if there's no inflation, which we believe there will be. And we're seeing in the price action of oil will continue to rise. In addition, with regards to the price per barrel of oil, because that is going to produce these companies a whole lot of money, that same phenomenon that has caused fear in investors from holding energy stocks is also causing energy stocks not to increase production of oil. Typically, in the past, we've seen prices rise and then prices fall as supply came on. This has lasted very long. In some instances, from 2010 to 2014, we remained above $80 a barrel the whole way through. However, we fell when production increased. It doesn't seem that's going to be the case now. U.S. producers don't want to produce. OPEC is having their fastest meetings on record. So the price per barrel is going to remain high. It seems Russia is even being hesitant to reiterate their prior statements that they will continue to supply resources to Europe. So it seems to me like the price per barrel is going to remain high and go even higher, and 80 is the new floor, and it's not that high relative to where things can be, but these stocks are making an incredible amount of money. Now, this might sound like a boring portfolio to you, and we know that. I'm a young guy. I want to make money, and I believe in a strong and prosperous future that is much more advanced than what we have today. So I have quite substantial allocation in my portfolio to investing in these notions. However, as I've said many times on this channel, I'm not buying stocks like Facebook, Apple, Amazon, etc. You know the FANG list. They're great companies producing great products, and I think Apple is producing exceptional products right now. However, they are very expensive and very crowded. And their potential for further growth beyond here is limited, in my opinion. Yes, they're going to produce fantastic products, but they're priced for that. And they're already producing fantastic products. What I want in this true growth, not FANG growth, true growth, stocks that have the potential to 10x, is just that. Stocks and companies that have the potential to 10x or revolutionize the world significantly more than it is today. Those companies certainly can, but they already have. So I'm looking at companies that are in the low billions or high hundreds of millions in price and have some order of magnitude technology. For example, I like CRISPR companies. Why do I like CRISPR companies? Well, if you can edit genes, you can cure all genetic disease. And if you can cure all genetic disease, you have found yourself a fantastic product and plenty of happy customers. So I have the CRISPR companies, some of them. I also have 23andMe, which is a similar genetics company. I have Jumia, which is the Amazon of Africa, trading at an incredible valuation. Hopefully they don't go bankrupt. We'll see. And this is how I'm thinking with this area of the portfolio. Between energy and materials and the growth, I would say I'm about 60% energy and materials and 40% the interest in growth. And I feel very good about this portfolio construction. Some of these companies can die and go to zero, even though I don't think any of them will. Otherwise, I wouldn't have them. But if one or two did, that would be fine because it's all going to average out. So that's how I'm positioned. I hope this helped you in some way. And please like, subscribe, and feel free to ask me questions. I'm happy to answer. You can comment down below. Tweet me. My Twitter is @BillyLeBou. And until next time, peace out.